Bring in show music, please.
This is Squawk Pod, and I'm CNBC producer Cameron Costa. On today's episode, Goldman Sachs CEO David Solomon in his first interview on set in years.
It's great to be in the studio. It's been a while since I've been in the studio with you guys, so it's good to be in the studio.
Really nice to have you here.
The markets, alternative investments, the economy, and the hot topic du jour, private credit.
We've had three events that on the face seem to be three idiosyncratic events.
Right.
You know, three idiosyncratic events does not make, a trend or a systemic issue by any stretch.
And we're zeroing in on New York City politics 2 weeks out from the mayoral election. Billionaire hedge funder and New Yorker Bill Ackman.
If Sliwa voters vote for Andrew wins. The key is Sliwa has to be out of the race.
What awaits New York on November 4th and, of course, November 5th.
You don't think the National Guard is coming here the day after the election? I do.
The policies on the ballot and Ackman's concerns about the Mamdani movement.
Where is Mamdani right? He's right that we have an affordability issue here. Okay, why do we have an affordability issue in New York? Rent is too high. Why is that? Right? The answer is because of policies that he wants to make worse.
Plus, Apple shares hit a record high and a spat between the PayPal mafia. It's Tuesday, October 21st, 2025.
You're not a boomer, are you? You're not a boomer.
No, I'm not a boomer.
Do you know, Becky, you're not a boomer?
No.
Anyone know the song Just Walk Away, Renee?
A very full Squawk Pod with our dynamic trio begins right now.
Stand Becky by in 3, 2, 1. Cue, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernen and Andrew Ross Sorkin. A strong day of gains on Monday for all of the major averages. In fact, at this point, all three of those averages less than 1% from their all-time highs. You also had the Russell 2000 that was up sharply yesterday. It is now less than 2% from its all-time high. And then gold, which was at another all-time high yesterday, this morning pulling back by just under 2%, $4,277 an ounce. You still have to think about that, how high we're getting on that dollar price. It was very recently that we crossed 4,000, and now you're headed towards 4,500 if you listen to a lot of the analysts, maybe even 5,000, depending on who you're talking to on this.
Meantime, shares of Apple, they can't be held down. The stock rising nearly 4% yesterday to a record close above $262 a share. It's a new report showing that iPhone 17 sales off to a strong start in the U.S. and China. Wells Fargo hiking its price target now to $290 a share. And this was Apple's new high of the year. Shares are up about 5% in 2025. They've lagged some of the other Magnificent Seven names like NVIDIA, of course, and Alphabet and Meta. But another move for Apple. This company is, it works.
Yeah, it's a laggard in AI, too. So anyone, thinks it's all AI and all a bubble, Apple. Plus, Apple, it's just amazing that how many times its demise has been greatly exaggerated, especially this year, too. But who doesn't? I mean, you got a 17 already?
Yep.
Everybody just loves the Apple phone and the ecosystem.
Bought another iPad yesterday. I must have like 17.
I need a new iPad. My thing is all cracked and shattered. I don't know how that. I think it's like if it doesn't work and you hit it, it has a tendency
to break. That what you do? That's
well, if you throw it across the room,
I'll throw it across the room. But I have hit it a few times because there's times that
better it than somebody.
But it's like. It was like the first the iPad that came out. How long ago was that? I mean, it's like
the first iPad that came out.
Yeah, it's old.
Or something.
It's really.
Oh, you have a very old iPad.
Really.
Okay.
You'll be amazed at how much faster they are now.
Really.
Yeah.
It's shocking.
I don't know if I'm going to get a new one.
President Trump and Australia's Prime Minister signing a critical minerals and rare earths agreement that the Australian leader said includes a project that planned to be worth about $8 billion. The U.S. looking to diversify its rare earth supply away from market leader China. A copy of that agreement released by the U.S. and Australian government said that each would invest $1 billion over the next 6 months in the mining and processing projects. They're also going to be setting a price floor for critical minerals.
This is really important as we head into this China trade talks. It does give President Trump something that kind of bolsters his position when you're talking about rare earths.
Definitely.
And what this means walking into
He said something yesterday, like within a year we're going to have so many. We have so many rare earth metals, they're not going to be referred to as rare anymore.
Yeah.
That's what he was saying.
It may very likely take longer, but having this partnership, having other places to go, anytime you start with export controls, it makes other countries look for ways that they can find these things without you.
Yep.
And that's what's happened here.
And that Jamieson Greer, the U.S. Trade Representative, calling out China for what he said was retaliation against companies investing in critical industries, U.S. industries like shipbuilding. In a statement, Jamieson Greer said recent Chinese actions were part of a broader pattern of economic coercion. Last week, the country sanctioned American units of a South Korean shipping giant over U.S. investment plans. And earlier in the day, President Trump reiterated a threat to impose higher tariffs on China if the countries can't reach a trade deal by November 1st. Mr. Trump also suggested that China's stance towards Taiwan expects that to come up at an expected meeting with China's president, and that's going to be next week. So we'll know. We'll know whether it's on and whether it happens.
Two early PayPal employees who have gone on to have influential careers in tech and politics sparring over the issue of AI. The fight began last week when one of the co-founders of Anthropic published an essay in which he laid out his feelings about more powerful AI systems. Now, responding to that was David Sachs, a former PayPal employee, now President Trump's crypto and AI czar. Sachs, criticizing that essay online, accused Anthropic of being, in his words, principally responsible for the state regulatory frenzy that is damaging the startup economy. Then on X yesterday, LinkedIn's co-founder and prominent Democratic donor Reid Hoffman called Anthropic one of the good guys, while also revealing his firm Greylock has invested in that company. Sachs responded, the leading funder of lawfare and dirty tricks against Trump wants you to know that Anthropic is one of the good guys. Thanks for clarifying that. All we needed to know. Hoffman came back saying, shows you didn't read the post. Not shocked. When you were ready to have a professional conversation about AI's impact on America, I'm here to chat. For his part, Sachs said he had read Hoffman's post, accused Anthropic of having an agenda to backdoor woke AI. So the debate continues, and it's happening online. Yeah, pretty intense.
You don't have to ask me where I stand, obviously.
I don't, actually. I and didn't.
And didn't. So I won't offer up anything. We do have Bill Ackman coming up, do we not?
We do.
And we do have David Solomon coming up.
Yes.
So
big morning.
That needs to be mentioned because of the headline is just so good. Okay, and I'm
just walk away, beret.
And I'll tell you why. Because you're not a boomer, are you? You're not a boomer.
No, I'm not a boomer.
Do you know, Becky? You're not a boomer.
No.
Anyone know the song "Just Walk Away, Renee"? The Four Tops did it after the Left Bank did, but that's what this means. See, that doesn't.
Oh, that didn't even click with.
That's what I mean.
Right.
That's how I guess the post caters to boomers, like me. But just walk away, Renee. I won't think calling you back. Okay, major song in the 60s, in 1966, by a band called the Left Bank. Who, just to end on a positive note, all four members are dead.
Okay,
Thank
folks. We will be talking to Bill
really
Ackman
cute. They look like the Beatles.
About whether what's going to happen in New York City.
Yeah, we're going to talk to Ackman
the mayor.
about it. I'm promoing.
We're very
and by the way, the
excited
subtext of
about that conversation.
is that even allies are telling Curtis.
No, the
Lewa
Post
to drop
in an op-ed says drop out Curtis.
And by the way, even if he does,
it's still
the math is still unclear.
And by the way, when Adams dropped out, he did not endorse Cuomo.
Right.
So.
Right.
Yeah, he might. He's close.
Well, we'll see.
What's he want?
When Hakeem Jeffries endorses Mamdani, maybe.
Cheese will be next.
Next on Squawk Pod, Goldman Sachs CEO David Solomon. Two regional banks rattled investors last week, sparking fears of trouble in the private credit markets. Solomon shares his view on private credit, lending, and the health of our financial ecosystem.
One thing I know for sure is when we do have an economic slowdown, and we will, or we do have a recession, we will go through a credit cycle, and you certainly will see, losses and pressure on those that lend and provide credit.
This is Squawk Pod with Joe Kernen, Becky Quick, and Andrew Ross Sorkin. Here's Becky.
Goldman Sachs is kicking off its 24th annual Alternative Summit today. Dignitaries from a wide range of industries will headline sessions at the event, including former Secretary of Defense General Lloyd Austin. former Treasury Secretary Stephen Mnuchin, former UK Prime Minister Rishi Sunak, Yale University professor of psychology Laurie Santos, and many other names. For more on that summit and the capital markets and much more, we want to bring in David Solomon. He, of course, is the chairman and CEO of Goldman Sachs. And we should mention that David is also a member of CNBC's CEO Council. David, it's great to see you. Thanks for coming in.
Thank you for having me. It's great to be in the studio. It's been a while since I've been in the studio with you guys, so it's good to be in the studio.
Really nice to have you here.
Thank you.
Alternative assets. You've been doing this for 24 years for this, but now alternative assets are everywhere. There's a lot of talk of this because of what the Trump administration has done with saying that it's going to be available for people's 401ks. What's happened? What's the evolution? What do you see right now when it comes to alternative assets?
Sure. And first, thank you for highlighting the Alt Summit. We're excited about it. We've been running it for a long time. We have about 450 LPs that are here. We obviously have a very scaled alts platform. We manage or supervise over $500 billion of alts across private equity, private credit, infrastructure, and real estate. And so we've been doing this, as you said, we've been in the alts business for more than 30 years. But the growth of private capital formation continues. And, candidly, I still think we're in the early innings of private capital formation when you look at the scale of it. I think it's very constructive for markets. Obviously, some of the private capital formation is also a response to the regulatory structure, particularly when you look at private lending and private credit. And some of that, in my opinion, is going to get rebalanced out, in the coming years. But it's important, and I think one of the strengths of the U.S. economy is that we have the most robust capital markets and capital formation system in the world. I was just in Europe last week, and it's a completely different ecosystem. You don't have the risk taking, you don't have the participation of retail investors and the stock market broadly, and so the private capital formation ecosystem here is a very powerful driving force for the strength of the U.S. economy and something we should all support.
Those alternative investments have historically been for wealthier investors, and there's the one take on it that, hey, everybody should be able to get access to this. The reason it's been a little more limited to individual investors is that sometimes these are pretty illiquid investments. And what does that mean for somebody who doesn't have a lot of liquidity or other things to fall back on? What do you say to people? How much should you have before you get invested in some of these things? What are some of the wariness, some of the concerns people should have?
Well, we certainly let investors speculate in lots of things with a lot of latitude.
More so lately.
That I think with a long-term view, certainly can be riskier than a diversified portfolio that includes some alternatives. I think, like everything else, there's time and place. Time and place matters, and I think about it appropriately. I have children that are in their 30s, and I think about their retirement accounts. An allocation of 20 or 25% in the retirement accounts, where they're really putting money away for 30 years and they don't need that liquidity. I think that makes a lot of sense for somebody that's working hard, is saving, is building a retirement. I think that makes a lot of sense, and so we are going to see more access to these products in a variety of different channels that allow investors to participate more. Whenever we do things like that, there are people that push too far, or there are practices that develop, and those are things that should be watched and need to be managed appropriately.
I'm thinking your kids have a really good future for some.
I'm very.
You're saying generic 30-year-old children. You're not talking about David Solomon.
I'm very proud of my kids. They are working away.
All right,
they're
but
independent.
I think
somehow they
going to be.
They popped out and they're doing great.
David, one of the things that I think about though is the private assets. The whole private world obviously uses sort of a different disclosure and transparency policy than public assets. And we're putting effectively those private assets in the public markets in this sort of unique way. And whether you think there should be either guardrails or different sort of auditing techniques or other things. I mean, one of the things about the NAVs of all of these funds is to a large degree they are being maintained or decided by the fund managers. And I wonder once you get into a public market space, whether they really need to be provided ultimately by some kind of third party or even fourth party that are somehow independently verified as we sort of get into a different place with all of this.
Well, I think you're raising a couple of things because private companies do have different reporting standards, although there are lots of private companies at scale that report the same way they would report, if they were a public company. That's different from valuation metrics against private investments and how private investments are valued and how those marks are moved over time. So I do think as there's more exposure of these products to broader markets, this is something that'll get discussed and debated. and I think it's an appropriate thing to think about. One of the reasons why I think that the activity, if we look at private equity in particular, that the activity or the monetization of the broad cut of private equity assets has been slower is because in 2020 and 2021, a lot of those assets were marked up.
Right.
The values actually declined below the marks, and the marks didn't necessarily follow. We've now been through a period of a few years where those businesses have been growing back into the marks.
So the industry,
that is something to think about.
But the industry would say that's a bug, that's a feature, not a bug, right? That the idea that you can actually hold those assets at a marginally different valuation than the public markets, that you're not marking it to market all the time, is actually a feature of that piece of it. I'm not arguing that's the case. I'm saying that's what they would tell you.
I think like most things,
you're a mark-to-market kind of guy.
I think we've been a mark-to-market firm in a lot of ways for a long time. I think it depends on the context. So that's fine if you're in something that's truly illiquid,
right?
Okay, and you don't have any liquidity option for years and years and years. If you are offering some sort of liquidity, a percentage of liquidity, whether it's on a quarter basis or an annual basis or something like that, then the actual value that's delivered when people look for liquidity matters, and then the marks become very important. So I think generally speaking, it's prudent to mark things for what they're worth and where they can be sold. There are others that would disagree strongly.
You're not guaranteed of doing well. I just, for the heck of it, went on AI and said, as Harvard dug itself out of its illiquidity PE mess that its endowment got into,
There was no bias in that prompt to the AI agent, was there?
It didn't go like this. It came up with a no immediately that Harvard has not yet dug it. And this is how far back does that go?
That was pre-financial.
Yeah, just before the financial crisis, and they're still got, 40, way too much, and they still can't get out.
There's no question the ability to monetize these investments over the last 5 years has been slow, but that's been a choice on the part of the managers, and that's reflective of the incentive system that basically they have a long-dated option to keep compounding the value.
If Harvard can't do it, should individual investors be expected to?
I think there's a time and place. I think there's a time and place for everything, but I think when you look at these products, you have to think carefully about time horizons, liquidity, and you really have to understand. But we certainly allow individual investors to invest in lots of things that carry a greater degree of risk if you're not factoring in liquidity.
More and more of these assets not being taken public,
yes,
it does raise the question of how do you get in on this? Do you agree with the Trump administration's push to say we shouldn't be reporting quarterly, like every 6 months instead?
So I've been thinking a lot about this. Yeah, I've been thinking a lot about this, and I'd say, first of all, I think there's an argument, a good constructive argument, that to have companies, public companies, reporting every 6 months in a full-scale reporting parameter would work well. There's a lot of work that goes into quarterly earnings. I know the arguments for transparency and the quarterly transparency, but 6 months is a very short period of time, and it allows companies, to focus on those true releases and spend more time, really focus on strategy and business. If there was, a shift to that policy, a lot of companies, including Goldman Sachs, might still report on a 4-quarter basis, or we might report 2 quarters where we really report, differently, a little light. We give information, but not to the same scale. But I think there are reasonable arguments. Companies should be focused on long-term performance. It's important for investors to have transparency, but I don't think there's a lot of difference between transparency twice a year and transparency every quarter.
Let's shift and talk a little bit about some of the concerns we've heard recently with private credit. It's certainly been a big issue with some of the regional banks. Zions Bancorp was up today after reporting yesterday, and it didn't look like there was additional problems there. But these markets a lot better than most people do. Do you have concerns about what's taken place there, about the standards for some of these credits, about the potential for fraud?
Well, it's interesting. You're talking about regional banks, and so you said private credit. Regional banks are lending, as they do. That's their business. I think that it is interesting that we've had 3 events that, on the face, seem to be 3 idiosyncratic events.
Right.
And 3 idiosyncratic events does not make a trend or a systemic issue by any stretch. I do think it's an appropriate time for people that are significant players in credit markets, given we haven't had a credit cycle for a very, very long time, to be looking at their portfolios, thinking about their risk management practices. And look, at the end of the day, credit is about underwriting standards, diligence, process. It's a very, very deep process-oriented investment practice. And, one thing I know for sure is when we do have an economic slowdown, and we will someday have an economic slowdown, when we do, or we do have a recession, we will go through a credit cycle, and you certainly will see, losses and pressure on those that lend and provide credit. We've just gone through a very long period of time. We have historically very, very tight credit spreads. And I think it's probably a time, to watch carefully. But I don't see things at the moment that lead me to say there's something broader going on. And without economic pressure, it's hard to see a real credit cycle. Although I guarantee things will pop up just as these things popped up.
We were talking to Rob Kaplan, who now works for you again,
yes.
Yesterday. One of the things that I think is up for grabs, and I don't know if anyone knows the answer yet, is the idea that so much of the credit market has now moved off balance sheet from the banks and is in the private credit space. Has that effectively de-risked the entire system, or is it as risky because there are these liquidity lines between these things, because there is leverage that's oftentimes offered by the banking system into the funds? What do you think?
Well, I mean, a couple of comments. First, one of the things I think is very important, sometimes I've heard people talk about the regulatory system, the unregulated system. It's one system. It's all interconnected. It's one system.
Meaning a problem anywhere creates a problem for the whole body.
A problem anywhere has an impact on the whole system. I think one of the things is we live in a world of remembering what's in the rearview mirror. So we remember, 17 years ago. And that doesn't mean every time we have a credit cycle or we have economic pressure that you're going to see something systemic in markets. And I think that's a very, very important point. People are talking, Andrew, to your point, a lot about, lending that goes to support the deployment of private credit. And you have to remember that a lot of that lending is securitized lending. I've seen some articles recently that said the people that are doing that lending don't really understand what they're lending to. That is not true. These facilities allow them to underwrite and pick credit by credit that are put into the facilities. These are secured facilities, generally speaking. And so, a lot of this is process, collateral selection, and I think most of the practices in the industry are good practices. That doesn't mean that there can't be, people that pop up who don't. There will always be. There will always be. You're 100% right, Joe. There will always be.
You can say, we got it this time. Underwriting standards across. There's always going to be people that are going to cut some corners to try and take business, market share.
Yeah, and one of the things that's happening is the flows, into these products have been significant. And so the people that have taken those flows feel pressure to deploy. And that's when you start to, when credit spreads are tight, you get late cycle, and we're definitely late cycle. Doesn't mean the cycle can't go on for quite a period of time, but when you get late cycle, sometimes standards decrease. And so I know there'll be places in hindsight that we can point to and say, there's another example of that, when there ultimately is a credit cycle.
There was a lot of talk of bubbles just over the last week, bubbles in AI, bubbles in markets. You don't particularly like that term. It's not one you want to use yourself.
Yeah, I don't like to be, over dramatic.
Bubble and bubbles.
I've been looking at tech multiples and trying to put tech multiples in a historical context. I've looked at a variety of data on public company tech multiples and, also private capital formation for tech companies. And it strikes me that, that the multiples are kind of 75th percentile or 80th percentile. So there's no question, we're somewhere in a cycle where the values are higher, but the growth opportunity coming from AI is significant. But I'm certainly in the camp that there are going to be winners and losers. Capital's been allocated to companies that are going to be hugely important companies, and it's going to be allocated to companies that that ultimately won't make it or won't succeed in that context. And ultimately, whenever we have a new technology, especially at scale, and you have significant capital formation around it, there are going to be winners or losers. We're not smart enough, to pick them all, and ultimately there's a rebalancing. But I think the long-term trends around this technology, the opportunity for productivity gains for some great companies to be formed is really quite exciting.
How about how you're using it internally at Goldman Sachs? Because you've made a lot of comments in the past about how this can really do the work for investment bankers much faster.
Well, I think there are a couple of base ways that we're using it. We're very focused on this. The first is we've always, since I started 40-some years ago, we get technology tools into the hands of really smart people to make them more productive. So I always joke about doing a common stock comparison 40 years ago. It took 6 hours. You had to go to the library, go get microfiche to get back issues of the Wall Street Journal. now somebody can do it in seconds, it doesn't mean we don't have a lot of very smart young people doing a lot of work. They're just doing different work than they did when I started 40 years ago. And so we continue to get these tools into the hands of our very smart people, and it makes them more productive. It gives them an ability to spend more time with clients, to do more. It scales our footprint, our reach. The more interesting thing we're spending a lot of time on, you might have seen last week, Becky, that we put out a memo where we announced what we're calling One Goldman Sachs 3.0, the evolution of our One Goldman Sachs operating ethos, is we're really looking at 6 principles, throughout the firm to operate the firm more efficiently, serve clients better, where we're looking at processes inside the firm and saying this technology gives us the right and the ability for the first time to reimagine these processes and really do them entirely differently, to automate a bunch of things, to create meaningful efficiency that then can be reinvested in growth in the business. It's not just taking out cost, it's giving us more capacity to invest in our business and grow. And so we announced that because we're doing a lot of work internally. And we said that in January we'll talk more specifically about how this can affect the business. And we wanted a framework to be able to really work inside the firm and really drive this forward. But I can't find a CEO that I'm talking to in any industry that is not focused on how they can reimagine and automate processes in their business to create operating efficiency and productivity. And that's a really good thing for economic growth.
Does that mean that this time is different and that it's not just going to make your employees more efficient, but it's going to reduce your headcount? Or
I don't think it's different. Technology has been having an impact on headcount, the way people work, what workers you have, for decades and decades and decades. And this, I think one of the things that's happening here that's a little bit different is this is going at a pace that's quicker.
Yeah.
And so because the pace is so quick, I think there's a possibility that there's a little bit more volatility or, an unsettled transition, around certain job functions and things like that. But at the end of the day, we have an incredibly flexible, nimble economy. We have a great ability to adapt and adjust. And yes, there will be job functions that shift and change. If you go back 25 years ago, we didn't have 13,000 engineers at Goldman Sachs, and we've shifted and changed. My guess is the mix of engineers with this technology will again shift and change, but I'm excited about it. If you take a 3 to 5 year view, it's giving us more capacity to invest in our business. And I see lots of opportunities for our business, but I still feel some constraints because we've got to deliver returns as to how much we can invest to grow our business. And this should free up more capacity to do the things we want to do to serve our clients and grow our business. And that's exciting.
What other acquisitions do you want to make?
Well, I'm excited about the acquisition we made last week.
I know. That's
if you humor me for a moment to say 2 words about it.
I'm very happy to, yes.
We bought a company called Industry Ventures, which manages about $7 billion of kind of early stage venture. It's touched over 325 venture firms. Hans Swilden, who's the founder of the business, an extraordinary guy. We've known this firm from a while. We had a stake, a 25% stake in the GP through our XIG business, and Mike Brandmeier in our XIG business, knew Hans and was close to Hans, and Hans approached him to say he was getting some interesting offers for the business, and Mike appropriately said, hey, let's bring this business into Goldman Sachs. And so what this allows us to do is really expand an offering to our clients and give more access to our clients to early stage venture. But if you think about our ecosystem, our banking ecosystem, our private wealth ecosystem, getting access to these businesses earlier than we would naturally see them in the life cycle of Goldman Sachs creates great synergy for us. And so we're quite excited about it. And I think this acquisition represents the kinds of things we're trying to do, things that expand our offering and accelerates the growth trajectory of our asset and wealth management business. And there are other things like this that we're looking at, some small, some bigger, but we really are trying to broaden and expand what we think is a very powerful asset and wealth management offering.
So if we were all sitting together 5 years from now, what would Goldman Sachs look like? Same?
I think 5 years from now, and look, there can be ups and downs in the world that can affect it, but Goldman Sachs will basically have the 2 principal businesses that it's in now, where it's a leader, it has a right to win, banking and markets, where I think our position is, without dispute. And then asset and wealth management, where we supervise right now $3.5 trillion of assets. We've talked publicly about the durable revenue in that business growing high single digit. If you look at our last earnings report, it's growing faster than that. And so we can continue to grow that business. I think we can add inorganically to that business to broaden that platform and accelerate it. And I think that those are two businesses that Goldman Sachs has a lot of room to run, a lot of room to win, and a lot of room to create value for shareholders. And so we continue to be excited about the value trajectory that the firm's on.
David, want to thank you for coming in today. We know you have to run, but we appreciate your time here.
Well, I really appreciate you guys having me.
Our next interview on Squawk Pod, billionaire hedge fund manager Bill Ackman. Historically outspoken in politics, he is now making a case to New Yorkers and to New Yorker business owners for November 4th.
All you do is you say to people, this is the most important New York City election we've had in 100 years. Okay, and it's not underestimating the facts here. All you need to do is get out of bed in the morning, okay, and show up at the poll, vote.
Where Ackman is putting his vote and where he hopes New York business will end up right after this. Welcome back to Squawk Pod.
Up and Becky, Q.
You're watching Squawk Box right here on CNBC. I'm Becky Quick along with Joe Kernen and Andrew Ross Sorkin.
Election day here in New York City is just 2 weeks away. It's become a national conversation. Joining us right now is a discussion about the mayoral race, the markets, the economy, and so much more. Pershing Square CEO Bill Ackman is here. Good morning to you.
Morning.
You have been quite outspoken on X and elsewhere about this mayoral race. A lot of folks around the country looking at New York as a proxy for what the Democratic Party even looks like. You've been calling on Sliwa to get out of the race. You've been calling on all sorts of things to happen. Right now, in terms of where you think things actually are, based on what the numbers are, we've been looking at Polymarket and other things, and it seems like Zoran Mandami is the clear favorite, not just the clear favorite, but that almost under any circumstance he's going to win at this point.
Remember, Polymarket is probability wins the election based on the facts that exist now. Probably accurate. However, if Sliwa were to say, I'm not going to run, right now the polls are the most recent poll is 44 Mandami, 33 Cuomo, and 19 Sliwa. I've seen polls that say the Sliwa voters are going to vote 65% for Andrew, 7% other, and 25% won't vote, something like this. But if Sliwa voters vote for Andrew, Andrew wins. The key is Sliwa has to be out of the race.
And does Sliwa not only have to get out of the race, and we were looking at the front page of the New York Post this morning, which was also calling for that. Does he have to get out of the race and endorse
He doesn't have
Cuomo?
to look, I think the smartest thing he could do for his legacy is to say, look, I love New York. I care about this city. I've put a lot of energy in keeping this city safe. The polls, the facts just tell me I'm not going to win this time. I'm going to step aside. I'm going to rely on Andrew to take care of the city. I'm going to keep doing my job protecting New Yorkers, and I'm going to run in 4 years. And then we'll build we'll have a gold statue of him in Times Square. And I know actually a guy offered to pay for a gold statue of him.
Let me ask you
gold,
this.
by the way, it's gone up in value a lot.
That's expensive.
Let me ask you this. We have had Cuomo on the broadcast. We've asked Zoran to come on. He has not come on yet.
There's a reason for that.
And there's an invitation that's still standing.
By the way,
if you're watching.
Here's what you should do. You should go to the DSA website. It says the capitalist economic system is the cause of violence, unemployment, and a climate crisis and poses an existential threat to life on Earth.
That's the Democratic Socialist.
That's the DSA, which is Zoran's policy. How can he come on CNBC?
So my question to you, though, is when you look at sort of the number 1, 2, and 3 issues that you have with him, and I am assuming that your vote for Cuomo is effectively a vote against him.
It is.
Right?
And I like Andrew.
What are the issues for you? Is it about capitalism? Is it about policing in the city? Is it about anti-Semitism? I mean, give me the list, but in the true priority, because I think there's a lot of people who think that maybe you're in this because you don't want your taxes raised.
Okay. So number one, I love New York. I love New York City. It's been very good to me. I care about this place. It's one of the greatest cities in the world. But it has issues. Okay, where is Mandami right? He's right that we have an affordability issue here. Okay, why do we have an affordability issue in New York? Rent is too high, right? Utility costs are too high. Why is that? Right? The answer is because of policies that he wants to make worse, right? Real estate developers would love to build more apartments in New York. There's enormous demand. right? Economics, if we increase, there's not enough supply to meet the demand, so what happens is rents go up, right? Why is that? Because we make it, one, extremely difficult to build. In New York, all kinds of regulatory, other not in my backyard protests, things that drive up costs that make it uneconomic to build new housing. Then there's rent regulation, right? If you're telling people we're going to freeze rents, well, number one, you can only freeze rents on 1 million, maybe apartments, not the other, 25% of the housing stock, not the other 75% of the housing stock. We've got 50,000 apartments that sit vacant because the owner can't economically afford to renovate them because they can't earn a return on the incremental capital they put in. If you look at places like Argentina, which deregulated, rent control, rents come down because supply comes back into the market. Some supply comes in immediately, apartments that are being held off, and then developers start building. What you want in New York is you want cranes everywhere building apartments, and that's going to drive down, that's going to keep rents from growing at a rate in excess of inflation. So affordability is a problem. Why are electricity costs so high? Because of Green New Deal, because of people fighting power lines, because of people shutting down natural gas, nuclear power plants. And that has caused the cost of, and we have all this demand from AI, of course, for power. That's made it more expensive for people. So he's right on affordability, but his policies are wrong. So that's an important issue. Another important issue is public safety, right? The mayor actually probably has more impact on public safety. That's probably the most important issue for most New Yorkers. And if he has a hostile relationship with the police department, right? Okay, you already are reading stories about people retiring in advance of Mamdani being mayor. If you look at what he said prior to the last few months of running for mayor, he was a defund the police are wicked, the police are evil. These are his words, his tweets, it's sort of in the record. That's not a guy who's going to be able to motivate the police. He's talked about, shutting down Rikers, right? So I would say affordability, safety, his policies are wrong. He's accurate in identifying the problems with the city, but his policies are going to destroy the city.
Explain why you think, in your mind, he is doing as well as he is, on track to become the next mayor of this city.
He's a very talented politician. He's charming. He's got a nice smile. Now, I would argue if you watched him in the debate, every time he answered a question, he'd finish with his smile. It's a constructed smile, and it makes me not trust the guy.
So here we are having this conversation. He now uses you and your name almost as a proxy to suggest why he should win, which is to say, interestingly, when you talk to especially younger people, they say, if the real estate industry, for example, if my boss hates him and doesn't want him to win, I want him to win because I think that he's going to help me.
And they're going to come to regret that. I mean, if you 1% was just a editorial in the Wall Street Journal this morning. 1% of New Yorkers pay 40% of the taxes in the city. And if you attack that 1%, those are the most mobile 1% of New Yorkers. And they can live 183 days outside of the city, and they can take their tax revenues elsewhere.
You've stayed here. You've been in New York this
Yes,
summer.
I have.
Would this be the thing that pushed you out of the city?
Look, what I would say is, putting me aside, it's a marginal cost decision for everyone who's in New York City. And you weigh the benefits of living here for 183 days of the year versus the costs. One of the costs is taxes, and not just personal taxes. Personal income taxes are going to go up. I think the bigger issue is he's talking about taking corporate income taxes for a business located in New York City to 21%. That's before you get to federal, right? And a CEO is a fiduciary for the shareholders of the company. And if you can locate the business in Miami and eliminate 21 percentage points of corporate tax, he's going to do that, right? So the matching New Jersey and forgetting that there's also New York City, New York City and New York State, taxes here. It's going to destroy the city.
There are national Republicans. They like New York, but they don't live here, and they think Republicans win the midterms if this guy gets elected and becomes it. The Democrats have a real problem, whether they endorse this guy or whether they accept him, because it's just acknowledging all these things that they know don't work, and they're afraid, they're so feckless that they can't say, we don't agree with any of that stuff.
You're right, and I think the Republicans are being short-sighted about this because I think there are follow-on implications for the rest of the country. If Mamdani is successful in New York, he's going to inspire other candidates.
Successful in winning.
Winning. He's going to inspire other DSA candidates at the state legislature, in other states around the country.
We'll know where the Democrat Party actually
So you're
is
right. If we
now.
destroy New York, it will set a bad example.
Maybe
right? But
it's
the problem
a
is
sacrificial lamb to out the current state of the Democratic Party and where the geographic center of that is.
It's the current state of the Democratic Party. And by the way, if I were a card-carrying member of the Democratic Party, I would be very concerned about this as well, because it's the party is veered.
What happened to
far
your
the
card?
left. What's that?
What happened to that card?
I never really had. I was always.
I know,
First of all, I was
I'm
always
kidding.
a centrist. To be super clear,
You were pretty woke. You were pretty woke for a while. Yes,
I was never woke.
In my view. And
now
then
we're like
I think-
simpatico. That's clear.
I left the lights on and you came home.
Okay, there you go. Thank you.
And welcome.
Thank you for welcoming. But in all seriousness, New York City is the most important, one of the most important economic
I agree
drivers
with you
for the
totally. I'm here every
country,
day.
right? President Trump is concerned about New York City.
And he, in his own way, that would be an unbelievable foil for him, Mamdani.
It's
Yeah, but
terrible for New
I
York.
don't think he wants it. I don't think.
Look, you don't think
How
the
does
National
anyone-
Guard is coming here the day after the election? I do.
Well, if it
King's
turns
gonna send him?
if we're shutting down Rikers and there are criminals roaming the streets and
They
people are
should be,
getting
exactly.
we become Chicago, yeah, we should have the National Guard here.
So let me ask you a different question, which is, to the extent that there's 2 weeks left and you would like to see Cuomo win, I think you not just have to convince Sliwa to get out of the election, you effectively have to try to persuade some of the voters that would otherwise vote for Mamdani to vote for Cuomo.
Actually, no.
You
All
think
we
not?
need to do is get out the vote. Okay, here are a few interesting facts. Typical mayoral election, what percentage of the registered voters vote? It's like 23
De minimis amount.
23 or 24%. Right? So if all you do is you say to people, this is the most important New York City election we've had in 100 years. Okay? And it's not underestimating the facts here. And all you need to do is get out of bed in the morning, okay, and show up at the poll. You're already registered. Vote. Vote for safety in the city. Vote for sanity. Vote for a place where businesses want to locate and keep jobs, bring jobs. New York's on actually, people underestimate Adams. He actually did a pretty good job. And the city is economically in a pretty good place. People are actually coming back to the office again after COVID.
Why
right?
hasn't
You look-
Adams endorsed Cuomo?
He should. He should.
do
Adams
you
should
think he
endorse
will?
Cuomo. I don't know if
And does
he
it
will.
matter?
On the margin, everything matters, but getting people out to vote, that's the most important thing they could do. By the way, every CEO of every company in New York City should say to their employees, I'm giving you, election day, come in after lunch, but vote. Vote for the future of New York City. We don't want a socialist candidate who believes in seizing the means of production. His words, right, on a video, right? This is what he believes. He's kind of modified, he's mollified some of his beliefs.
What do you tell the people who say, look, you know what, the mayor can't do that much anyway?
Mayor can do a lot. If you care about safety in New York, the mayor, first of all, he's not committed to keeping Jessica Tisch, who's done an excellent job, right? Why is he not committed to keeping her? Because he knows, he says he's not keeping her, it's going to lose votes, but he's not going to keep her. There's no way. It's going to bring in his own person on crime, and we're going to see more crime.
Let me ask you a slightly different question before we get to the markets and everything else. What do you think happened? This city has been the financial center of the universe for a very long time. Do you think that would shift if he was the mayor? And I ask because Jamie Dimon just opened up a beautiful new headquarters and has invested an enormous amount of money here. And so there is this view, especially among Mamdani's supporters, who say nobody's going anywhere. Everybody says they're so mobile, but look at what's happened. These buildings are here. They're going to be here for a very long time. Maybe a couple people move here and there. The city's going to be fine. I'm just...
The problem with that analysis, look, I think J.P. Morgan's going to have a meaningful presence in New York City, but also, look, if you focus on hedge funds for a moment. Hedge funds are a very important taxpayer and the employees who work for them in New York City. They're the most mobile businesses in the world. Ken Griffin left Chicago because he was upset about everything from people getting killed on the streets to the way that dysfunction, the way that city was run. And he went to Miami. And Miami's becoming a financial capital, and it's becoming a more desirable place to live. And they're opening, a lot of the New York City restaurants have opened, duplicate examples there. The weather is very good most months of the year. I don't think J.P. Morgan is going to leave in the next 4 years. And no. Do I think many hedge funds will go? Many financial services businesses? I mean, what happened post-COVID? Post-COVID, people figured out that they could actually do a lot by Zoom. And that made it a lot easier to, it used to be you had to be physically in New York so you could go to a meeting and see someone. Zoom, it's still good to see people in person, but a lot of meetings that you used to do in person, you now do by Zoom, which makes other places like Miami much more viable, Palm Beach, et cetera.
You've been asking for a conversation, a meeting on X with the person who may very well become the next mayor, unsuccessfully. Do you ask that? I imagine you're asking it genuinely, but do you believe that he would correspond with you?
Well, look, the guy's attacked me personally, so I'm like, okay, let's have a real conversation. Are you afraid to have a discussion with me on X, an open mic discussion where I can ask you about your policies and I can challenge you about your policies? Why not? As opposed to, having, I would say open mic, give me a couple of hours and let's understand who you really are. I'd love to do that. The fact that he's unwilling to do that, he's not responded to do that, I think speaks. He's afraid to do so.
While we have you here, got to ask you about your take on just where we are in this economy and where we are in the markets. What do you think? We keep talking about, we say there's a bubble in conversations around a bubble.
Yeah. I would say there's a lot of positive. Let me be optimistic for a moment. I'm negative on New York if Mondami's elected, but I'm positive on the country. Clearly we have the most pro-business president we've had in a very long time. And we also have a lot of very significant things that have been announced, but the effects have not yet really taken effect. So one, infrastructure bill from the past. We have the more recent tax bill, which gives 100% depreciation for investment. We have this massive AI, infrastructure investment that's like building the railroads of the early part of the 20th century. We have the productivity effects of AI that are only just starting to have a significant effect. We have interest rates coming down meaningfully. The 10 years below, 4%. We have a Fed that's accommodative, likely to sort of cut interest rates. So these are all, I would say, very positive for the economy and for markets.
Bill, there's a time when I think you wouldn't have called Trump the most pro-business president. And when a lot of people, you were worried about tariffs, a lot of people were worried about tariffs, obviously, in April. Is it that those tariffs never really came, the worst case scenario, obviously, didn't happen, and probably at this point most people think are unlikely to happen?
No, actually, I think Trump has been the most pro-business president we've ever had.
But that's even when tariffs were going to hurt the markets at one point.
I was a little bit concerned about the scale of the tariffs and how quickly they were about to be implemented.
Yeah.
My suggestion to the president was to take a 90-day pause, and to his credit, he modified that position.
So he is pro-business, even though people say these tariffs are.
By the way, he doesn't care if the stock market goes down in the short term. He cares in the long term, and I trust the president, and I think he's done an excellent job.
What about?
I think he's also done an excellent job. By the way, the other factors that affect markets are kind of geopolitical risk, and I think geopolitical risk is coming down. Yeah. Right, the whole Middle East. The Middle East has been reset.
If he wasn't Donald Trump, I don't know what his approval would be if he wasn't Donald Trump. Given
if you actually objectively look at his accomplishments, it's been an incredible presidency.
But what about the Chinese trade talks that are coming up again? Because we are reaching the end of that kind of extended pause.
Look, you can't bet against the president and his ability to negotiate deals. I mean, you can't. And the Middle East, the Israel-Gaza situation, a peace dividend from the Middle East could be massive, right? We have these countries with incredible resources. Only thing holding back the Middle East has been Iran, terrorism, the sort of axis of evil. Well, the axis of evil has taken a major, major blow. And I think that's a great, that brings down risk premium sort of globally. So again, I think there are a lot of reasons to be, optimistic about the world.
Where are you on the relationship with China?
I wish we had a better relationship with China.
You do?
Absolutely. I think it's really unfortunate that two of the most important powers in the world are at loggerheads, and I just think we should make peace with China. I think that'd be very, very good. That would be an incredible white swan. Let's put it that way.
Let me ask you a slightly different question about maybe capitalism on a different front, which is this administration has been uniquely taking stakes in businesses. They're interested in switching grants potentially at universities to effectively take stakes in patents and all sorts of things. What do you think of that?
What I think is that the United States allowed other countries to control to use a Mandami term, the means of production,
Right.
and make the United States vulnerable. Whether it was chip manufacturing or active pharmaceutical ingredients or rare earths, and that created a lot of vulnerability for the country. And I think what the president is doing is trying to solve that problem by enhancing the competitive position of Intel and sort of anointing these companies. If Intel failed, and by the way, if you look at a stock price chart of Intel, it was on a very negative trajectory for the business. That's a threat to the country.
It's not a perfect way to do things, obviously. Maybe Intel should have failed.
I think that would have been a mistake.
Right, but
first of all, what the Biden administration did is it gave money to Intel.
Right.
What Trump said is, I want to get a return on my investment.
So picking winners and losers, solar, picking any, renewables or electric cars, none of that stuff.
Yeah, look, I think you should be cautious about the government stepping in and becoming a capitalist force. At the same time, if the government is going to provide some form of subsidy to an industry, getting something back so the taxpayer gets a return on the investment, I think is a very smart strategy.
This AI boom.
It's incredible.
Incredible
for the world.
As long as the eye can see? Or, do you think that there's indiscriminate spending? Do you think that it's...
I think it's a bit like the railroads, a bit like fiber. The worst case scenario is we have excess capacity. But I think what we've seen is, intelligence is not something that you're ever going to have excess capacity for. So if and when we achieve AGI, right, this is a Lollapalooza effect for the world. We're going to, will enable us to. We're already starting to see impacts on, cancer discovery, so imagine a world where we can, address every disease, right? Imagine a world where we can, the power of superintelligence is worth a meaningful investment. Will some of this money, will some companies go bust? For sure. But I wouldn't have bet against,
I'm not laughing at that.
The alphabets of the world have the resources to make these investments.
For Andrew,
a profitable business.
I was going to call the Post, that New York paper. I won't do that, obviously. We know about the gray lady. But they do say this effect, be an angel and go away, Curtis. And then they say, for the sake of the city you love so deeply, Curtis, please swallow this bitter pill and drop out.
Yeah, I think
that's pretty good.
I respect the guy. Okay, I have nothing against him. I know he cares about the city.
He's not going to win. So
all he is doing right now is handing the city to Mandami. It's an ego thing. I don't know what he's thinking. Okay. And by the way, if he were at 31% and Cuomo at 19, I'd be supporting him.
The slightest chance. But did you understand Perot? People do this. Look what's happened over the years in the national elections.
Yeah,
whatever her name was.
Remember, he's not the first time he's running for office. He lost to Adams. He got 28% of the vote against Adams. So he's already failed to become mayor in a much less competitive situation.
Bill Ackman, I want to thank you for joining us this morning. Really appreciate it. It's great to see you.
Incredibly important election. If you're a CEO, let your workers, let your employees.
Vote early and often.
And by the way, vote early. Critically
vote
important
early
election.
And often.
Really important for New York.
You don't need an ID.
For public safety, for business here, for the country.
From New Jersey, I'm going to vote.
For the country, for the future of the country. We do not want a socialist leading the most important financial city in the country. We don't. Someone who wants to seize the means of production. Okay? This is bad stuff.
Thank you, sir.
That's the podcast for today. Thank you for tuning in. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin weekday mornings on CNBC starting at 6 a.m. Eastern. To get the smartest takes and analysis from that TV show right into your ears, follow Squawk Pod wherever you're listening now. We'll meet you right back here tomorrow. Have a great day.
We are clear. Thanks, guys.